A nightmare scenario is imminent. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, risk assets are about to crash as a massive amount of liquidity is about to be pulled from the financial system. We're going to show you where this liquidity drain is coming from and why it means that stocks are likely to crash. And despite the fact that experts are saying that the labor market is strong, today's manufacturing report says just the opposite. In fact, that a bunch of layoffs are about to hit. Let's head over to Bloomberg, where we picked today's story up with the headline: Wall Street fears $1 trillion aftershock from debt deal, as this move would drain liquidity from the system, hurting riskier assets. And what's important to believe here and understand is the market believes that as liquidity enters the financial system, it is really bullish for risk assets, even though from the standpoint that banks do not go out and buy stocks. A lot of people believe that that's where this liquidity is coming from, and that's not the case. But the other flip side of the story is, as liquidity is pulled from the financial system, well, it's pretty bearish for risk assets. Is there any truth to this? Well, as you're about to see, there actually is. Ari Bergman, whose firm specializes in risks that are hard to manage, says investors should hedge for the aftermath of a Washington resolution. What the market veteran is getting at is that Treasury will need to scramble to replenish its dwindling cash buffer to maintain its ability to pay obligations through a deluge of Treasury bill sales. Estimated at over $1 trillion by the end of a third quarter, the supply burst would quickly drain liquidity from the banking sector, and we're going to look at how that's actually going to happen. We're going to show you kind of the mechanics of where this liquidity is and how it's going to be drained from the system, so you can see exactly how it will hit risk assets. Raise short-term funding rates, which we're going to argue perhaps is not the case, and tighten the screws on the U.S. economy just as it's on the cusp of a recession. By Bank of America's estimate, it would have the same economic impact as a quarter-point interest rate hike, when we're already now hearing from Fed speakers that potentially they may go for another 0.25% hike in June, and they seemingly just don't have enough. But this liquidity drain, according to Bank of America, will have the same effect, putting us potentially to see 2 more rate hikes, or the equivalent of 2 more, in a very short term. Let's take a look at deeper what's going on here. Higher borrowing costs in the wake of the Federal Reserve's most aggressive tightening cycle in decades have already taken a toll on some firms and are slowly crimping economic growth. Against this backdrop, Bergman is especially wary of an eventual move by the Treasury to rebuild the cash, which they'll have no choice to do, seeing a potential for a massive reduction in bank reserves. Now, the question you might have is, well, what is a bank reserve, and what does this have to do with any of this liquidity drain? Well, let's head over to Investopedia now and take a look at a bank reserve. Are the cash minimums that the financial institutions must have on hand in order to meet central bank requirements. This is just cash, either in physical cash or held on its account at the central bank. And these are requirements, again, held by the Fed. The question is, do we even know what that is? Does it even matter? Well, we do know what it is, and oddly enough, it doesn't matter. Because here you can see on March 15, 2020, the Federal Open Market Committee reduced the reserve requirement ratios to 0. And that has been in effect since then. And that means it eliminates all reserve requirements by all depository institutions. So the fact that this is going to drain reserves and perhaps have a negative impact in a system right now that requires no reserves kind of suggests that maybe that's not exactly how this is going to play out. But perhaps in another way, I'm going to show you, it is actually bearish for risk assets. My bigger concern is when we get the debt ceiling gets resolved, and don't worry, it's going to at some point, you're going to have a very, very deep and sudden drain of liquidity, which is actually the case. This is not something that's very obvious, but it's something that's very real, and we've seen it before that such a drop in liquidity really does negatively affect risk markets, such as equities and credit, and that is indeed true. And we're going to show you here in the charts in a moment that it does have an impact on risk assets. And again, as I started the show out, has nothing to do with the banks buying or selling stocks. They don't do that. That's not part of what they're doing with, their cash holdings. It just has to do with how the market reacts to liquidity injections and liquidity withdrawals, one being bullish, the other bearish. When the Treasury issues more bills than it technically needs during a certain period, its account swells, pulling cash, and this is the key part, out of the private sector and storing it in the department's account at the Fed. Now, one thing to understand here is when the government issues debt, they go to auction, there are three bidders. There are domestic investors. They can be very, very large investors. That's not the issue. You have domestic investors. You have foreign investors, which would also be foreign central banks, and then the rest goes to the commercial banks. They're also bidders for their own book, in a sense, for their own clients, but also as dealers to mark up and sell to make a profit. So you have three effective bidders here, and we know that the commercial banks, on what their role is, if no one else wants the debt, if there isn't enough demand, they have to take up the rest here. And what we're starting to get the impression from this article is it's going to be pulling this cash out of the banking system, perhaps if there's not enough demand elsewhere, and there could very well be. Another important piece of the puzzle is the Fed's reserve repurchase agreement, perhaps the biggest issue here, dubbed the RRP, which is where money market funds park cash with the central bank overnight at just a rate of over 5%. Now, why does this overnight reverse repo even matter here is because these money markets typically invest in T-bills. Now, if there's a shortage of T-bills, which we can make the case there actually is, then of course the Fed steps in and says, look, we have an emergency provision here. You can come to this facility. We will lend you the bills you need on an overnight basis so you can pay interest on the money markets, and we will take the cash. So there is some idea that if there is a large amount of T-bill issuance and the market believes the Fed is going to pause the rate hike cycle, that we could see the money markets absorb a lot of this, and that would effectively neutralize the liquidity drain. But the concern the author of this article is making is, what if the money markets don't want these T-bills and the banking system is forced to absorb them? Now we're going to have an all-out crisis. That program, currently over $2 trillion, is also a liability to the Fed. So if the Treasury account increases but reverse repos drop, then the drain on reserves is lower. As I just suggested, that if money markets absorb this, it's not that bad. But here we see from Citigroup, it says money funds' tendency to keep cash in reverse repo will most likely persist only because the Fed keeps talking about higher rates, which could mean a sizable drain in bank reserves when the Treasury's cash jumps. And that would come as a major central banks have already been siphoning off liquidity through aggressive tightening campaigns and efforts to unwind their balance sheets. So here let's take a look at kind of what's going on with the Treasury general account. That is shown in blue, and against the overnight reverse repurchase agreements in red. Now, mind you, these overnight reverse repurchase agreements aren't really a big deal. They're not supposed to be a big deal. But notice here, as the Treasury was draining its account balance, we saw here in 2021, the reverse repo amount of money when in that surge is sitting around $2 trillion. The issue, as the author is making here, is that what happens if the Treasury general account goes up, here you can see circled in yellow, at the same time the reverse repo goes up. That is what they're referring to as a liquidity drain or a liquidity crisis, and that's what we're going to look at to see how it affects both the equity market and the bond market, which right now everyone is saying is bearish for both in a big way. And as we talked about in yesterday's show, PIMCO said that means short-term rates could go up to 10%. Of course, we said that's not likely at all. We're shifting from a very significant tailwind of global central bank liquidity over the last 6 months to probably a significant headwind. What we really care about is reserves, which should be falling. I'm strongly leaning to risk off at this point. And if you only had a report that could tell you when risk off was coming, well, CTA-Timer Pro does. When you see extreme positions like this, where it says 100% long, and you start to see a reversal, the report tells you not only when you're high and you need to start cutting back your risk, it tells you when things are low and you need to look at taking on risk. So if there's one report you had in your arsenal that will tell you and give you that warning sign that it's time to back off, tighten up your stops, this is it. $30 a month while supplies last. Check that out, link in the description below. Because now the question is it bearish for risk assets? And the answer is yeah, absolutely it is. But you'll notice here in 2020, when the Treasury raised the cash and issued a bunch of T-bills, well, guess what? Risk assets rallied. But notably here, you'll notice what happens at this point when, of course, we have that dual point where reverse repo and the Treasury accounts were rising, which I'm not showing the reverse repo on this chart. Look what happened to equities. Almost in a lockstep, they actually declined, suggesting that indeed this is bearish for risk assets. Now, a lot of people, as I suggested in yesterday's show, such as PIMCO, says, hey, wait a second, we don't care about this inverted yield curve. We think short-term rates are going to the moon. Well, what does this mean for interest rates? Well, it suggests they too are going to rise, but maybe not as much as you think, or perhaps not at all. Here we can see 3-month T-bill rates under the same condition. They took off and went higher, suggesting again this liquidity drain not only is bearish for stocks, but bearish for bonds, but holds fast because what does it mean? Well, if we look at the federal funds rate on this chart, you'll notice it didn't look like it changed much because we went from the 3-month T-bill to the federal funds rate. So the question is the reaction in the bond market, at least the short term, more about Fed policy than it is a liquidity drain? Well, the evidence says absolutely. Here we can see on this chart, we've got the 3-month T-bill rate, the federal funds rate, and the 10-year Treasury yield. And yes, it suggests, as we know, that perhaps the front end of the curve is more in response to monetary policy, as you can see right here, than it is to anything to do with the liquidity drain, because we can note that back when the TGA went up, rates came down because the market was driving rates lower, including the Fed. So the idea here that interest rates are going to magically just go higher because there's a liquidity drain, well, there's no real evidence to suggest that. All the evidence points to the fact that for whatever reason, this is highly bearish on risk assets. But what do you think? Do you think this means stocks go down, bonds go down, commodities go down, or does it mean nothing? And those things all can go up. Love to know what you think. Weigh in the comments, because now let's take a look at the labor market before we get into the manufacturing report from today, because the labor report says everything may be okay, but when I show you the details of manufacturing report, we're going to say, no way, this is just a pause in a much higher move of initial claims. U.S. jobless claims tumbled last week after fraud inflated jump. Reversal in Massachusetts helped spur the biggest drop since 2021, as initial unemployment claims fell by 22,000 to 242,000 in the week ending May 13th, and also on an unadjusted basis, claims decreased by the most in 2 months to 215,000, suggesting that perhaps the labor market is indeed much better shape than even I want to admit. But continuing claims, which include people who have received unemployment benefits for a week or more, are a good indicator of how hard it is for people to find work after they're losing their jobs. They've edged down, but have held right around 1.8 million. So we're not seeing a whole lot of movement there. So what it tells us is people that are hitting the unemployment market, some of them are getting jobs, but there's not enough new jobs being created to bring those continuing claim numbers down in any material way. And what this is suggesting, kind of what my view is, that at some point, as these initial claims break through and over 250,000 on a sustainable basis, that is going to outright shoot higher as the economy falls apart. And here you can see the 4-week moving average of initial claims with the baseline at 250,000 weekly claims. And we can note that only a couple times in history have we seen such low initial claims, but every time they broke that 250, they shot higher. We see that here in the early 70s. We see it again in the mid 70s. We're going to exclude the pandemic here, but look at now, what we're seeing is a potential move here. And the reason why it doesn't have to be such a big move that everyone looking for and is expecting is because when you have a lot of people work, and even if you have a relatively small percentage that leave the labor market, well, the fact is their spending does matter. And as their discretionary spending goes down as they hit the unemployment market, well, it has broad reaching effects on the economy. That's why we don't need to get to the typical number of 350 weekly claims or 350,000 that many believe. I'm holding on to 250. We'll see if I'm right or wrong. But this next report says perhaps I am right. Here we head over to the Philly Fed, our favorite Philly Fed, because we use them in our charts all the time. Notably, in their survey responses collecting from May 8th to the 15th on their manufacturing business outlook, they noted that in the region, they continue to decline overall. So what this means is, what we're going to see in the numbers, I just want to preface this, is manufacturing slowed, but at a slower pace. So it's still in decline, but just not as fast of a decline as last week or last month. But remember, these reports do oscillate quite a bit month to month. It's the trend we're caring about. And the survey survey's indicators for general activity, new orders and shipments rose from last month, but all remain negative. On balance, firms reported a decline in employment, again suggesting that we are going to see continued initial claim numbers head higher as the price index remained below long-run averages, with prices received index declining further. Let's take a look at this in a little more detail, because I want to show you that even though the headline says, hey, you know what, it's weaker, but not as a reduced pace. So look, we're slowing down, but not as much now. So that's usually a good sign of a reversal. But let's take a look at the under the covers here. What do we see? New orders in contraction, shipments in contraction, unfilled orders almost neutral. How about delivery times? As this goes down, that means things are getting places quicker. Inventory is rising. This doesn't sound good on the front end of this. Look at the prices paid. It's up 10.9. Prices received down -7, meaning they're being squeezed at the margin. Prices at the factory level are going up, but they're not commanding that when they go to the market. Number of employees, -8.6. How about the average work week? This is critical, -7.7. So what we're seeing here is employees are working less. There just isn't demand here. And what does that all mean for the labor market? Well, let's first look at where the factory gauge says the future is, and I'll show you the chart that says whatever this view of the labor market is totally wrong, and the claims are really likely to head much higher. Future indicators softened as the diffusion index for future general activity declined 9 points, which isn't much, to -10.3, the third consecutive negative reading. So again, the trend, the outlook, it remains negative, and almost 37% of firms expect a decrease in activity over the next 6 months. Future new orders fell from 9.8 to -2.3. So again, suggesting that perhaps things here going forward are pretty bad. And when we look at new orders, just current, not future new orders, but current new orders, I want you to see here in blue there can be a surge higher. You notice the gray bar is a recession, so you see, hey, look, it was bad, but look, it looks starting to look better. And here you can see in the 1990s, oh look, see, we're not in a recession, we're pulling out of it. Here you can see into the dot-com bubble, a trend down, oh look, a rebound, we're okay. Same thing with the global financial crisis. We're in the midst of a recession, but look, we're getting a rebound here, we're coming out of this. The same thing is happening now, but when you overlay the 4-week moving average of initial claims, look what happens. They shoot higher. They shoot higher. They shoot higher. Shoot higher, higher, higher. So what is it telling us? My friends, that initial claims data, while noisy in itself, and we look at the factory data and say this could be a transitory, just move higher in the optimism inside the factory indexes, and that perhaps a much larger move is headed as, of course, the spending from all of these people that are unemployed start to go away. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.